Hi there, welcome to the CRE Syndicate, where we discuss commercial real estate and today's real estate news. I'm Julie Tallman, and I am the Investor Relations Specialist with Pre-iShare. The CRE Syndicate show is sponsored by Pre-iShare as well as Family Office Insights, and I'll go through and introduce the rest of the hosts and two very special guests that we have today. Arthur Bavelis, he is the founder of Family Office Insights, and he's going to be a regular here, and you're going to want to hear what he has to say. We also have Mike Anderson, who is the president and CEO of Pre-iShare. He's been in real estate for 45 years and is usually very well averse to what's happening in commercial real estate news. We have Christian Sadler. He is the Pre-iShare VP of Investor Relations and is working on so many different relationships and new strategies within commercial real estate, and is kind of the face and the voice of Pre-iShare if you followed Pre-iShare at all. So you'll be hearing more from these gentlemen. I'd like to introduce a special guest today, Robert HEFTY. Robert, you're the founder of Cobalt Investment Partners, and you oversee all of the investment projects for Cobalt Investment Partners. And I want to introduce a little bit from your bio as well as a little bit about your company so that we can lead into what we're doing today. Robert, you spent the first 15 years of your career working in customer support, business development, operations, in technology, and were responsible for the development and pricing strategy for all of your customers. And the reason I'm saying all this, I want to lead up to, you were one of the key components in taking that company from 500 million per year up over 11 billion. So year after year, massive growth, which is, kudos to you and your team there. Another thing I thought was really cool, I got to read this, you were the 1998 Big West Student Athlete of the Year for volleyball, bachelor's degree from College of Creative Studies, and earned a PhD in physical chemistry from MIT. I would say the words well-rounded come to mind. I don't know about anybody else, but Robert,
thanks, Julie. Yeah.
Welcome, and thank you for being with us.
Yeah, no, thanks. It's, I've dabbled in a lot of different things, so it's been an interesting history to get to this point.
Perfect. I know your company, Cobalt, you guys have a really unique kind of value add. Can you, before we jump into today's news, can you give us a 60-second spiel on kind of your primary strategy and how it's a little different from some of the other companies out there?
Yeah, sure. So I actually entered real estate from kind of the point of view of making deals and putting deals together. That's what I did for my company when I was working in business development, was kind of set pricing strategies and package deals and figured out how to pull different elements together to bring a deal to life. So I entered the space working with brokers and kind of working on that side of it. And we look at opportunities primarily in the industrial real estate space. Maybe there's some vacancy, maybe there's some tenants that need to be improved, maybe there's some other value add physically to the building that we can do. And we try and, buy a property that has some value add upside to it, do the value add work, re-tenant it, and then collect the cash flow or exit the property as appropriate.
Fantastic. Well, thanks again for
Robert, I want to lead in with a quick question here. Where do you primarily source your capital? At that stage of growth, I think everybody wonders, how do you source capital at that scale?
Yeah, so we've mostly built it around a friends and family network and grown through referrals. Given my history, I have a number of colleagues and my partners have colleagues from the semiconductor space. So a lot of those people that we work with are heavily invested into the stock market and options in their companies and don't have a lot of exposure to real estate, in particular commercial real estate. So we like bringing those opportunities to them. There's a few athletes that I've played with. It's an eclectic mix on that side. And then we've been working with Arthur to build more relationships with family offices and kind of grow our network, because we see a long fruitful life of real estate opportunity here in the East Bay where we work, that we, will need deeper pockets to eventually tap into some of those opportunities.
Yeah, Julie, if you don't mind, just a big shout out to our Robert and my common friend Daniel, who I've known for years, is a smart guy, also an investor in Cobalt, and that's how we met. So it's been like what usually happens is just a nexus, a connectivity thing, and so that's how we were acquainted. So, and Daniel's a really smart guy and young and robust is probably a good word to use for him. So that's how Robert and I met. So we're super glad.
Robert, you guys have one more partner, is that right?
Yeah, actually, we have kind of a network of partners that are associated with our group as well. There's one more individual that's specifically inside of Cobalt Investments. And then there's several partners that we joint sponsor deals with that we've done the last 4 or 5 deals together with, that have kind of more specific knowledge around the tenant space and around the kind of industrial construction space, that kind of fill out some of our experience.
Your website does a really good job of just saying, here's our team, here's what we do, here's opportunities. Tell me, say the website again.
It's cobaltinvestments.net.
There you go.
Well, I'm excited for what you're going to add to the conversation today, Robert, and I would love it if, Arthur, you jump into the shakeup. What are some things that are happening right now that could shake up the commercial real estate world?
So there's a number of things, but one of the things that comes to mind that we talked about earlier today was, and I think it's not only going to shake up the commercial real estate, but also credential a accredited investor in a more meaningful way. In fact, Michael and I talked about this the other day as well. There's a bill that passed Congress and going to the House that essentially will allow you, based on certain certifications that you have, or taking a test that would qualify you as an accredited investor, rather than just determining that by some asset level that you might have. And I think that Michael had a good comment about this, is just because you have money doesn't mean you're smart enough to invest. And so the objective, and it's sponsored by a congressman or senator in Texas that I don't know if you guys remember a guy named Wayne Huizenga, but his son is in politics and he has sponsored the bill. And the objective is to get more people through an exam. That the objective is to get more people in a better way to determine whether you're an accredited investor, and that you actually have some credentials in being able to invest as a sophisticated investor. So I think it's probably a more meaningful way. It's hard to say what, when you see sausages made in the Congress and Senate, it's not always with good intentions, but I think this one is. So I think the outcome is going to be is if you have a CFA or you pass an exam just as a pedestrian investor, that you can then be qualified to participate in what you otherwise would not be able to participate in. And as it relates to commercial real estate, as you know, many of the raises that are done only to the audience of accredited investors. So I think it's going to open up the opportunity not only for people who are syndicating investments, but those that want to participate. So it's pointing in the direction of good things.
Especially if they raise the levels like they're talking about for accredited investor, what's it called? Yeah, to become eligible, those numbers are supposed to jump way, way up.
The SEC is still they're requiring that the SEC come in and review whatever the credential status is every 5 years. So I think that's what's prompted this bill as well. And just as an aside, I happened to see Tony Robbins speak the other day, and he was promoting his new book, which is all about investing and having the average person to be able to invest like the rich person, the 1% of the 1%. And so he was talking a lot about this bill, and participate in being able to have a wider audience, a wider swath of the population to participate in things that they would otherwise be able to.
I saw that as well, and I heard that the House voted to pass the legislation, but is that, do we know where it stands? Is that definitely going to happen? Does the SEC now just need to create the test, or where
No. Yeah. So I just looked at it, and so my memory's not serving me very well. But just before I hopped on, I happened to look at it. It had nothing to do. I didn't even know we were going to talk about it. But it passed the House, and it went back to committee, and it had been proposed back in June of 2023. So it's going through the factory, so to speak. So it passed the House. It got put back into committee for comments. And so the next step is Congress to see if they pass it. And then it goes to the president, sign, and goes into law. So for the record, I put myself on an alert there, which I'm not sure the NSA is going to really appreciate me being on some government website. But presumably I'll get a notice when things start happening. Yeah.
Well, it's interesting, the dichotomy between the two, because I was reading something on the opposite side of the scale, which is they did this review in December, and it's really, and I've got some notes here, but there's what's called the Regulatory Flexibility Agenda, which allows the commission to consider changes to Reg D. And what they're basically saying, if you go off of when the original status was created, they're looking at potentially, it used to be that only 1.8% of American households would be accredited investor status. Right now, it's 18.5% that meet those requirements. And if they made changes to match the inflation, which I'll go over those numbers in a second, it would take it down to only 5.5% of American households that could even participate in offerings that require the status of being an accredited investor. So essentially, what you're looking at right now is, and let me just scroll over here, if they matched inflation, that $1 million threshold would move to $3 million. So you'd need a $3 million net worth to be an accredited investor. And the income thresholds from an individual would go from $200,000 to $607,000. So you'd have to be making $607,000 to meet the status, or as a couple, it would move from $300,000 to $911,000. So on one side, you have this bill that's potentially opening up these opportunities, some of the best opportunities that you can find to the average person. And on the other side, they're saying, we're going to cut out all of these people who are already meeting the standards and investing. I'd love to hear you guys' thoughts on both sides of that coin.
Robert, have you been tracking this?
This is news to me, actually. I have not been tracking this. It's interesting because a lot of our, especially on the athletic side, that, you know, they're not in the high paying demographic typically for what they're making on their day jobs, and they qualify through their assets. So changing those limits may have an impact.
Yeah.
Michael Anderson, I would love to hear your feedback on this as a sponsor for how long? How long were you a sponsor?
Long enough.
Finding investors.
Your mic's off.
For
your mic's off.
Oh, you're on mute, Mike.
No, it's not. Yeah, I've been syndicating too long, I think. But yeah, you know, I think the financial standard that they set, the SEC set, was really more along the lines of being able to fend for yourself, which that really denotes that if you got into a bad investment, that the government doesn't have to come in and wind that investment to get your money back, that you have the wherewithal to go after the sponsor that put you into that deal. That's why I've always thought that asset-based or even income-based standards for accreditation is just so subjective. I can remember years ago, we would go to, for example, you go to California and it's like, geez, do you own anything in California at all? Any piece of real estate at all? And people would hold up their hands, and most everybody in the room would hold up their hands. They were all accredited. You know, it didn't matter what they owned because they met the accreditation standard anywhere else in the country, and that was not true. You know, and it was so I never really thought that that was a great standard in and of itself. When we were doing it, we also had this, we tested on suitability. And suitability to me was more about, do you understand the investment? Are you sophisticated enough that when you make this investment, that you're making it with full knowledge of what you're doing? Again, I stand by what I told you, Arthur. I think that it's just because you have the money doesn't mean that you should have the right to invest it.
That's right. Yeah, for sure.
And I think it's important not only to protect the public, but it's also, I think, as any syndicator can tell you, that if you get somebody that's invested in one of your offerings and doesn't really understand what they're investing in and doesn't understand the risk, they're a liability not only to themselves but to you. So and could be to the investment, pool that they're invested in. So I kind of like the idea that they're shifting more from, maybe they're going to increase the amount of financial regulation or requirements, but I really like the idea of testing for sophistication. You know, I think that that's more important.
Yeah, and that kind of echoes. So the government says that the review is about finding out whether somebody has the financial sophistication, ability to sustain risk of loss, and ability to fend for themselves. And what you're saying is, just because they have money doesn't necessarily say they have any sophistication or even the ability to fend for themselves.
Yeah, all they're saying is if it goes bad, you've got the ability to rectify the problem yourself. You can fight your own fight.
Yeah.
You know, a better answer would be a more sophisticated investor that makes a good choice.
Yeah. Yeah, it's interesting also that just because you have money, we don't know how you got it.
Well, yeah, you could have inherited from,
Right.
and, you know.
Yeah. Yeah. Daddy probably bequeathed it.
Yeah.
Right. So, which is nothing wrong with that, although mine didn't. But
so let's talk about if it went just one way and all they did was shift the accreditation status to all of these higher standards, what would that mean for the market?
you mean if they stuck to their knitting and used it asset based as a method and implemented the cost of living or inflation type numbers? Yeah, I think that it would shrink. I think I don't know exactly what the other impact would be, but the amount of qualified people to invest in deals would shrink.
Well, and it's interesting to think about all these people who are already invested who suddenly become unavailable to invest with the people they may have been doing business with for years. I mean, that would be such a shakeup to the market.
Yeah. Yeah, and let's call it what it is. There's a lot of people who say they're accredited investors, and there's not really a lot of teeth in certifying that. And so there's people out there that say they are, but aren't. So maybe that would promote that sort of behavior even more.
Yep, I agree.
That could happen.
Yeah, but then Arthur, that just shifts the burden to the sponsor.
Yeah, the syndicator. Yeah.
Yeah, that's all that happens. And so, and if you can't, so the burden of vetting has always fallen on the sponsor for that. And they don't go chase the individual investor that might have falsified their information. They're going to go after the sponsor, and they can unwind the whole syndication on that. You know, and it's, yeah.
Well, and I
just think that asset base or financial base is not really a true standard, other than you can fend for yourself. That's the only reason it's there. It's just don't let the government have the burden of trying to chase your investment down for you if it goes bad.
Yeah. Yeah.
And the scary part about that is the government, they don't have a no harm, no foul clause, right? So if the burden is on the sponsor and more of this becomes prevalent, that's really a scary scenario. And you know, not to get political, but you think about what's happening in the Trump case right now, where, you know, he borrowed money, paid that money back with a profit, and they're potentially, you know, charging him legally for that. What would they do to a sponsor if you happen to take in a series of investors that didn't meet these new standards?
Well, yeah, that's a great point, Christian. I mean, and it even, you know, he never defaulted on any of that debt, but I guess it's a little bit different. Well, maybe not. When you look at it as, was that bank fraud and you falsified your statements to the bank? But is that any less fraud if you falsify your financial information to your sponsor? You know,
Yeah. And the way that it sits right now, as you said, they don't go after the person who claimed to be accredited. They go after the person who raised the money.
yeah, they certainly didn't in Trump's case. They certainly didn't go after the banks for accepting falsified statements or not verifying them or anything else. But I know from a sponsor's point of view, I know that they would definitely go after the sponsor in that situation. So it still keeps the burden on the sponsor.
Yeah.
I don't see it any other way. To me, I just think that the direction's the wrong direction.
So one of the things that I found in the past, when these sort of laws change and the consequences are yet to be determined, because it has to get into practice to see, you know, even though we can pretty much agree that the SEC is going to go after somebody where they think they can apply guilt and then have resources to pay for whatever the victim might have suffered. You know, they're going to chase the money, right? But what I've seen in the past is once these things get implemented and there's some time that goes by, all you have to do is go to your insurance companies who are insuring those risks, the E&O and the D&O and all that kind of stuff. And they've done the hard work because they're writing the checks to insure people against that sort of consequence. So it doesn't help immediately, but eventually the insurance companies are going to have done the hard work to see really what the consequence of that type of law being changed. It's really
But
another data point.
Arthur, don't you think they just work off the actuary tables? They just say, how much are we losing in that area and adjust the premiums accordingly?
Yeah, exactly. So if they've determined that, okay, we're losing money on this area and therefore we have to raise the rates, then you've got a pretty good data point on what the consequences are, right?
Sure. Yeah.
And so adjust your behavior accordingly, maybe, right? It doesn't mean that it's good news. It just means you've got to prepare yourself to, you know, put a defense fund in, right?
Well, it could be good news in one respect. It might limit, it could be a barrier of entry for
Others, for others.
other syndicators. I mean, you'd have to have some degree of sophistication and some degree of track record within your team in order to get the E&O or D&O insurance that you would need.
Yeah.
Robert, it sounds like most of the people you were dealing with were at the upper echelon of income, but did you ever have this scenario where you were potentially dealing with somebody who wasn't an accredited investor wanting to participate in what you were doing?
Yeah, we've avoided that. I mean, we do kind of reverse due diligence on the people that we work with, to make sure that, you know, everything's board. We have a pretty small operation, so we don't want to encumber any kind of, you know, securities liability or anything like that. So we kind of try to take steps up front to prevent that. You know, so from our point of view, it's not a specific risk that we're concerned with. I do think, Michael, what you were saying is really relevant. If there's not a way for people to qualify in, I think you're going to see a decrease in the amount of people that are participating in a pool, And in our space, we're kind of looking at a gap in the market between 5 to 20 million, where it's a little bit smaller than some of the institutional guys want to look at. And the opportunity to buy product in that space may feel a lot of pressure too.
Yeah, Robert, when I was raising for multifamily, and that was our sweet spot, about 10 to $20 million per SPE. And that was just, mom and pop investors.
Yeah.
Occasionally we would do a deal with institutional investment and single investment on an SPE, and pretty soon we realized that we were not the GP any longer.
Yeah.
So it really did work well when you had those individual investors, and our typical pool was 20, 30 investors in a particular SPE, and that worked well. Governance worked well, the operations worked well. What was nice, kind of, I was identifying with your statement, it was like friends and family. We had that same group of investors. We worked with a group maybe of about 400 investors, 200 of them were active, and we worked with that same group for 40 years. You kind of get to know how everybody's going to react. How they're going to think. They're going to know what they're going to be interested in, what they're not going to be interested in. And you certainly learn their level of sophistication.
Mm-hmm.
And I think that was what really did work. Now today with the Reg C, you can just go out and do a general solicitation, and you don't know that investor. And if you don't take the time to understand them, you could be buying a world of problems. I know when we launched pre-iShare, one of the things we were trying to do is buy this put a secondary market together for the people that needed to get out of those investments early and out of their passive investments. And we started the process by working with sponsors and getting them approved onto our platform. And interesting enough, so when we went out to advertise for that, immediately the sponsors who had guys that were in their investment pools that they didn't want to work with any longer were forced onto our platform. So
Yeah.
So it kind of tells you.
Give it to Mikey.
Yeah,
Exactly.
It kind of tells you that maybe the real answer is maybe knowing the people that you're investing with a lot better and knowing their level of sophistication rather than how deep their pockets are. That might be the more important thing. In my mind, it is anyway.
So let's devil's advocate here and switch to the other side. Let's say that this bill goes through, and now all of a sudden you have anybody who, I don't know, is it 18 years old? Anybody that gets to 18 years old can take this test. And you have all kinds of people wanting to invest in your deal. What are the potential benefits and challenges there?
Hold harmless.
Yeah.
There is, it could be a nightmare.
I don't think you can go quite that far as just the ability to defend for yourself. I still think is an important part of it, because you certainly don't want the SEC unfortunately does not have the ability to fully regulate all of the private equity markets, and so to a certain extent they have to be self-regulating, or you've got to have people that are investing in it can actually fend for themselves. So that qualification I don't think can go away, but I don't think that that's the answer in and of itself. It's just by saying just because you've got a high net worth that qualifies you to be to take on passive investment like that.
Well, I'm actually saying on shifting to the other side, if everybody can take this new test and become an accredited investor, no matter what their financial status is, I mean, where does that really put us? I mean, there's kind of there's that a lot of different memes and things out there about the guy who's sending you $500 or $5,000 is basically, you know, telling you that he's risking his whole life, and the guy that sends over $5 or $50 million says funds are wired, let me know how it goes, right? So you're dealing with a different level of challenge in taking on more investors who have less financial well-being.
So maybe, Christian, maybe the standard should be that you could look at like a Reg CF, where, you know, you can invest up, you know, up to 5,000 or, you know, smaller amounts. So maybe what it is that you can only venture a percentage of your net worth, or a percentage of your income, or something that can go into passive investments, something of that effect. I'm still a fan of Reg CF, only because it gives my kids and my grandkids a chance to get invested into something, you know, other than the stock market. And real estate's always been really good for me, and it's been very good for my family. And I would like to see them get into real estate. I just don't know how in the world they can even get into their own home right now, let alone an investment in real estate.
Yeah, it would be interesting to see what types of limitations might come with accredited investors due to this test. And I wonder if it's not that this isn't happening on purpose, because they're talking about those inflation numbers and sponsors and everybody going, holy cow, how are we going to get investors? So they'd really have to make sure that even if they're educated, they're still protected.
Yeah, and if you follow the money, sometimes it tells the story, right? So it just so happens that Hunzinga was a huge real estate developer, and I think he had something to do with the stadium down there. Like, this is not, you know, without some sort of agenda, right? And on some level or another. I'm just, you know, when I was listening to this, and I don't think it would work, but imagine if the SEC said, you can take this test, and if you pass it and you agree to take the test and pass it, check this box here in our terms of service, as the SEC says, you can't come to us to save your ass. Like, I don't know how that would work, but, you know, we never read any terms of service in anything that we subscribe to. And they could probably just hang that out there and say, well, you took the test, you took your own responsibility. Don't come to us for a rescue.
Yeah, why not? Why not indemnify them?
Yeah.
You know, maybe another answer would be is that you could build for if you're not qualified or accredited investor, and don't have the financial wherewithal, that a prerequisite to not only the testing, but a prerequisite to investing would not only go through a testing process or an education process, but you contribute to a legal defense fund.
Yeah.
You know,
I like that
something like
idea.
that.
Yeah. Not bad.
Yeah. I mean, I know they have that in the, you know, the real estate commission, right? Where they have the fund that essentially protects realtors who say stupid things or do stupid things along the way. They're protected to a certain point, and maybe that would be the thing. And, you know, that the whoever runs that is going to be the people who take that, just like any insurance company, and reinvest those earnings and make a killing off of it.
Yeah.
Well, let's set up that business. I like it.
Yeah.
Yeah.
You know, Arthur, the thing that kind of irks me the most about it is traditionally real estate investments do extremely well in high inflationary periods. It's the greatest hedge against inflation there is, because it's leveraged for no other reason. And if you make it, and to Christian's point, if you make the adjustment based on the dollar amount, you know, of your net worth or of your income, and then you adjust that every year based on inflation, you're locking out the very time and people when you want to be getting into the real estate investment business.
Yeah.
You know, everybody knows that when you get a period of high inflation, there's a lot of money that flows into real estate.
Yeah.
Just because that's when the opportunity is being created. One of the many ways of opportunities being created in real estate investment. So I find that somewhat ironic, but.
Hey, Christian, would it be okay? I happen to know a fair amount about one of the deals that Robert's working on, and the fascinating thing about it to me was the way it came about and why it's a value add in a meaningful way. And I'm not promoting the deal, but I'm just saying the way it pieced together was super interesting to me. It's the big warehouse or the operating company, the one in across the bay, right? Am I getting it right, Robert?
Yeah, it's in Berkeley. Yeah.
Is it, Christian, is it okay if we talk about
Tell
this?
us about it.
Yeah.
Yeah, so it is an interesting story. So 40, 50 years ago, two friends had a print shop, was the beginning of the story. They operated that print shop for years. They were massive. They had a warehouse across the street from their building there where they kept $1 million of paper inventory at all times because they were just cranking out printed books and pallet measures and everything else. They ended up selling the business and they kept the real estate and were living on the rent. They passed it to their kids who inherited it and had no knowledge or interest in how to run a real estate project. But the person that was the tenant had a very low rent. So when they went to try and sell it, the tenant sued them and took him to arbitration, won his arbitration case. He had, a yellow pad of paper with scribble marks on it that he said was a lease extension. The judge agreed, gave him an extension. So basically they were unable to sell this property. And one of the colleagues that I mentioned earlier that I work with that kind of stays in the tenant space, caught wind of it and went to the owners and said, look, when you sell this, you're going to have to do a massive amount of due diligence because it's been a print shop for 40 years. So there's probably environmental issues. There's all kinds of deferred maintenance that you're going to have to take care of. We'll agree to buy this from you in the future, but get a long-term sort of an option contract on it. And we'll do the due diligence in the meantime. So that was about 3 years ago now. And we've just now finally got the tenant out and we're working on, the architectural build plans and all of the details to put the project together. But it's been interesting because, nobody knew if the tenant was going to leave this time or if he was going to try and come back and get another extension. So just the discussions with the owners and the negotiations around how to define the purchase agreement based on different conditions that might or might not happen was pretty interesting.
Is there still a print business?
There is.
Yep.
So he to everybody's surprise, including the brokers and the owners, he moved out and moved his print business to another building location. So he still exists. He actually prints a lot of the California state ballots. So he's been busy lately.
Are they pre-filled?
Yeah, right. Exactly. Prints multiple copies, maybe. I don't know.
Well, this is off topic from the deal specifically, but it brings up a point that I've been coming to wind of over the last couple of years. I've been a little bit spoiled in hanging out with Michael Anderson and a lot of the passive investors that I've met, because I used to have a little bit of an ego. I've always been an independent real estate investor, and I used to think I wanted to leave this legacy of these different properties, and different businesses. And then I've seen enough people now that have passed on their real estate or their business, and the kids knew nothing about it, didn't want anything to do with it, and really ran it into the ground and got very little compared to its real value. And that's what I'm hearing in this scenario. Whereas a lot of these passive investors, and Mike, you remember when we sat down with that gentleman here at the mouth of the canyon, he's already working on second and third generation of the wealth from him. And he's planning on leaving them these passive investments with good operators, and the operators do all the work. And then when they return the capital, the kids can choose to do whatever the heck they want with it.
Yeah, it was interesting sitting there because it was like we were selling to an investment committee, but it was really his family. I noticed that same thing that you did, Christian. I thought that was really kind of interesting.
And now I'm at the point where I could care less if I own any real estate by the time I pass away. I would rather leave good investments and maybe some clauses of how they use the money when it comes due.
You've
Yeah.
got, you've got time. So
It's a
what's,
great point.
so last time we were talking about this, Robert, there was a little glitch in the matrix and that's been resolved, right? With the tenant getting out?
Yeah, so the tenant is out. Like I said, we just received this week our permit set of drawings to submit to the city. The city's another interesting group to work with. The city of Berkeley isn't known as being the easiest place to try and get building permits done. Fortunately for us, they actually have a carve out in their zoning language where manufacturing is a protected use within the city. They want to keep those blue collar jobs. So for us, we're working with a planning consultant, but we're basically making sure that we don't have any impact to the use as it's already designated. So we should have, in a matter of 4 to 6 weeks, the approved permits and be moving forward on the project. But yeah, it's great. I mean, we feel really awesome about this deal. We got an appraisal done over the summer because the interest rates were still going up and we weren't really sure where things were going to kind of level out. And it appraised 50% above where we have it in contract right now. So, we're pretty stoked to be moving forward with the project.
Nice.
Nice.
Yeah.
How much value add are you going to have to do to kind of rehab that building?
So it's all in, it's an $18 million deal. 8 million is the purchase price, and we're putting in basically 5.5, and then TIs and leasing costs. So it pretty much needs everything cosmetic. It needs a new roof. It obviously needs paint, window glazing cleanup, clean up the concrete in the manufacturing floors. And then we'll redo the restrooms and the offices, but leave the manufacturing as a shell for somebody to move into.
Well, shameless plug here. I think you would fly through our sponsor approval process if you wanted to have this listed on the listing hub and have us come out and do a feature on the project as a whole.
Yeah, maybe we'll have to pick up the conversation after this.
Don't worry, Robert. I'll catch up with you later.
Yeah.
Yeah, perfect.
You are
Yeah,
toast.
it's exactly the kind of project that we like to do because our last deal, we kind of bought a similar building in Jack London Square, which is in Oakland on the waterfront. And it was another vacant building. We cleaned it up. We built out a lab inside of it and have a non-dairy cheese manufacturer that is making a hard meltable cheese in that space. So we kind of like developing space into a higher level use. Even though it starts out basically warehouse quality, we'll have power, we'll have a TI allowance where we can give some money to some of these tenants that don't want to take on the CapEx, but are trying to do, new and exciting things for kind of the Bay Area and the engineering and the development economy.
Robert, I think about the butterfly effect, and I mean, there's some big pterodactyls that are falling there in California when it comes to retail, big shifts in the valuations and how the real estate market is being affected. How does that affect you guys when it turns over to the manufacturing space?
Yeah, it's actually one of the reasons I got into industrial in the first place. So when I started out in real estate, I was more focused on office and kind of downtown boutique retail space. Because those are the brokers that I had been following around in the market that I learned originally. But over the years, I've shifted to focus more on industrial. And the reason I like it in particular in the Bay Area, and in particular on top of that in the East Bay, is because there's a phenomenal infrastructure of engineering and business in the area that just drives constant change on what's being created. So, guys at Apple and Intel, they may grow into a space, grow out, move out of the area. Then you have different groups coming in that are making different products. Now you have a bunch of battery tech. But the point is there's an ongoing economy of innovation, and those companies always need somewhere to get their parts from somewhere to get, an electrician that has a warehouse that, needs to be within 2 hours of getting to a site if he has to do a repair. So the communities don't want to build any more of this product. But there's a fairly high and consistent and ongoing demand, I think, for the next 15 to 20 years in this area for kind of multi-tenant, mid-size industrial and manufacturing.
Nice. Can you share with us if you have something to share about what it looks like from the outside looking in to the Bay Area on the, what's going on in the streets and the depression in the urban areas and
Yeah.
Give us your read on that from somebody that's been on the street.
Yeah, it's not as bad as the news would have you believe. There are certainly areas where there's some sketchy stuff going on. Our project in Jack London, if you go under the freeway a couple blocks, it gets a little dirty. But in general, the industrial areas and the areas where there's manufacturing and cities have kind of focused on sustaining a level of just quality of street cleanliness and basics like that, are pretty robust. So, we try to buy in those areas. Occasionally, if the price is absolutely right, we'll look in maybe a neighborhood that's not the best, but most of the stuff that we're buying we're looking for higher demand areas because we know that the people that are going to work at these places are going to want to work in a nice area and be able to park their car and kind of do all that normal stuff that engineers need to do to get their jobs done.
Yeah. It's good to hear the real story, right?
Yeah, I mean, Berkeley in particular has done a much better job recently of trying to clean up and deal with some of the homeless. If you go to areas of Oakland or San Francisco, you definitely see it is pretty bad. But some of the cities are focusing their energy and efforts on making sure that they're keeping the streets safe and people are able to go to work and normal business can proceed.
Well, that's good to hear.
Yeah, I'm also curious, as an outsider, I hear about the challenges of the landlord-tenant laws. I'm guessing that it's a lot different when it comes to commercial. I wonder if you could talk about the differences there.
Yeah, definitely different. So the only residential type product that I have is just personal homes that I own and rent out. I don't do any syndications or any business with multifamily or anything with beds. So, and part of it is, that part of it is that, and part of it is there's so many people that are doing it. I feel like given my background and Arthur, you mentioned Daniel, my other partner also has a semiconductor tech background. We kind of know what people are going to want that are going to be moving into these spaces. So we feel like we have a good eye for finding something that is going to be useful, that maybe is run down or needs work. But on the leasing side, it's, whatever people will agree to, you can come to terms on a lease. It's not highly regulated in the same sense that the housing is.
And
Residential.
apparently you can extend your lease on a legal pad by
Yeah,
yourself.
right.
Exactly. Maybe not today, but certainly 30 years ago, apparently that was kosher. So I don't know. Yeah.
Write your own deal.
So, I mean, that's one of the reasons I've shifted a lot of my own portfolio to commercial real estate was the challenges you deal with a commercial tenant, business tenant versus residential is just completely different.
Yeah. And I mean, I really like the multi-tenant industrial space. I kind of say it's multifamily adjacent. You have a lot of the same security and steady tenant demand that you have with multifamily. It's, maybe not quite that robust, but it's a pretty solid pool of people that need to have a small, 5,000 foot, 10,000 foot space to run their business from.
So
Robert,
if somebody was in a different area of the country, not competing with you, was maybe in multifamily or something, but was interested in getting into more of the industrial side of commercial real estate, do you have a top 1, 2, 3 bits of advice or what they should look for?
I think look for you know, there's certain elements of buildings that make them desirable, and then there's, you know, areas that make the buildings desirable. So you're gonna want to buy in areas where there's demand for labor, to be honest. I mean, industrial is typically serving the kind of the blue collar workers of the world. So if there's plumbers and electricians and things that are doing a lot of work in that area, if they're building a lot of houses, there's going to be demand for industrial space close by.
Jobs.
Mm-hmm.
Mike Anderson knows about that. I worked with Michael Anderson 20 years ago, and he's just big on find the jobs, find where the people are going to be living, what new companies are going to come in. He's an econometrics pro, but he won't admit it here on camera.
Oh, yeah, I will. I'll own it.
Yeah.
Nice. Yeah.
So I got a question for you, Robert. How big does it play in? Because I heard you use the terminology innovation centers and tech development and so forth, driving industrial manufacturing and so forth. And
Yeah.
that's particularly true in the Bay Area. How important is it to be in a college town where you got to, and
You
then-
know, I think it helps. I actually, so the reason I like the East Bay, the colleges certainly help. You have a lot of innovation that comes out of colleges that starts a lot of startups. Those startups, especially in the Bay Area, you have the financial infrastructure to fund the work that those guys are doing. So there's definitely a machine related to that. But what I really liked about the East Bay and why I started focusing on it when I got into real estate initially is you have this expansion of San Francisco and Silicon Valley that's happened over the sort of backwards looking 50 years. And as those areas have grown, the people that started those companies, you know, started to have families and started to do other things in their lives. And the people started moving east because they wanted to have more land or a bigger house or whatever it was. So as those people moved east, then you had the accountants and the lawyers and the tax guys that need to service those people's moving east. And then you have, sort of just a self-sustaining growth of people getting pushed out of, if you want to call it that, the peninsula and the San Francisco area. And that's certainly increased since the COVID situation and work from home and people kind of trying to find a better at-home work solution. But even without that, I think that sort of momentum is going to carry forward for, several years.
Yeah. Yeah. If you're in manufacturing, it's hard to do a work from home job.
Mhm.
Yeah. And I mean, one of the case study examples that I'll talk about is when I was working at my company, we were based kind of closer to the Bay. We opened up a manufacturing center that was out kind of at the edge of the East Bay at the time. And we did it for cost savings. But what ended up happening is the product quality got better and the manufacturing time got shorter because the people that were working in that manufacturing area lived closer to where they were working. So they were more effective at doing their job. And that was a sort of an unintended benefit that we realized, not going in looking for that at all when we started out. So I just, anecdotally have seen that happen. And I think, as we can talk to founders and people that are running their companies and looking at where they want to be, convey some of those things to them as well to help sign leases.
Yeah. Yeah.
Not having a 2.5 hour commute, being stressed out, you're going to get home and have dinner.
Yeah,
Wow.
exactly.
Yeah.
Yeah, it's a lifestyle people are getting sick of real quickly.
Yeah. And in particular, if you're grinding on the manufacturing floor, if you're turning a wrench on making a part and doing assembly, you don't want to go sit in your car for 2 hours after doing that all day.
Such a
Totally.
good point.
Yeah, that makes a ton of sense. I really appreciate you being on with us here.
No, that's great. It's great to participate in the conversation.
Yeah, it's really nice.
Great. Thank you to both of our VIP guests, Michael Anderson, Peri Share, and Robert Hefty, Cobalt Investments. And what else do we need to cover? What else do we need to do here?
I think that wraps it up. Unless
Yeah, no, I
anybody
think
has
it's good.
final
Hey,
thoughts.
Robert, that was great. Thank you so much. Yeah.
Yeah, no, it's my pleasure, Art. I was happy to be invited to come and chat with you guys.
I'm gonna tell Daniel that you're all right.
I appreciate that. I can always use a good word with him.
Yeah.
And
Yeah.
this was just a friendship test.
Yeah,
Robert, you and Arthur are now friends.
yeah, exactly. Perfect.
And for
Yeah.
everybody who's watching, thanks for joining us.
Thanks so much. Wow.
Yeah, bye-bye.
Thanks, guys. Awesome.